Hey everyone, I want to talk to you for a few minutes about how we journalize our closing entries, okay? Before we get started, go ahead and pause, go to Canvas, Chapter 4 module, and get the sheet, the file that's called Information for Chapter 4 Video, Journalizing Closing Entries, okay? I'll wait for you. Okay, so what we're going to do is, in the closing process, we've already discussed how we are making certain accounts, our temporary accounts, have zero balances. So, and that was in a different video. Today, I just want to actually show you how to journalize the closing entries. On your sheet of information, you have a trial balance that has all the company's accounts listed. We know that from these accounts we make two closing entries. The first closing entry, we are going to close all of our revenue accounts and all of our expense accounts. We know that to make something have a zero balance, we do what? That's right, we do the opposite. Revenues have a normal credit balance, so to make them be a zero balance, we would debit them. So I'm going to look on my list, on my trial balance, and I'm going to find my revenue account or accounts, and I'm going to debit them. If I look at my list, I only have one revenue account in this problem, sales, and it has a balance of $50,000. So I debit sales for $50,000. Now I credit all of my expense accounts because expenses normally have a zero balance, and so to make them, expenses normally have a debit balance, so to make them zero, we have to credit them. So I look on my trial balance and I find I have a salaries expense account. So I credit salaries expense for $15,000. Sorry, I'm tongue-tied today. And then I see I have advertising. So advertising expense will be a credit for $2,000. And then I have accountant's fees. So maybe you'll be getting paid some of those someday. And I'm going to credit them for $1,500. So notice on this trial balance, we didn't have the word expense after our accounts, but we've gone far enough now that we know the accounts, one, that come after our revenue account, our trial balance, would be our expense accounts, and we know salaries are an expense. Now you might be thinking, but sometimes don't we have a salaries payable account? Yes, and if a company has more than one account that starts with the same word, they will always put the word payable or expense after it. So I kind of did that on purpose just to give you a little real world taste of how accounts might be listed. So we know that debits and credits have to always equal. Do these equal? Does $15,000 plus $2,000 plus $1,500 equal $50,000? No. We're not done with this journal entry. Think about it. Revenues minus expenses. Sound familiar? It better. Revenues minus expenses gives us our net income. So since we've already done our financial statements in the real world, we already know that our net income is $31,500. $50,000 minus $15,000 minus $2,000 minus $1,500 gives me $31,500. So I know that I need another credit for $31,500 to make my debits and credits for my journal entry equal. I am going to credit the owner's capital account. And I guess since I'm the one up here writing, I get to be the owner. So Dancy Capital, $31,500. What does a credit do to capital? That's right, it increases it. So what am I doing? I am increasing capital by the amount of net income. That should sound familiar. Yep, the statement of owner's equity. On the statement of owner's equity, we increase capital by net income. So we've been writing it on our statement of owner's equity since chapter 1. But this, our closing entry, is where we actually make it come true. Remember, the only way to change an account balance in accounting is to make a journal entry and post it. So, I may have been increasing capital on the statement of owner's equity, but that was just a report. Now, I'm actually increasing capital by the amount of our net income. Number 2, our second closing entry is to close the owner's drawing account. So if I look at my sheet, I find withdrawals of $10,000. Withdrawals drawing normally has a debit balance, so to get rid of it, I will credit it. That's right. I am going to debit the owner's capital account for $10,000, and I'm going to credit the owner's, I'm going to put drawing because it's shorter, drawing account for $10,000. So what am I doing here? What does a debit do to capital? A debit decreases capital. And what does a credit do to drawing? It decreases it. So I'm making drawing have a zero balance, and I'm decreasing capital. So I am decreasing capital by the amount of the owner's withdrawals. Sound familiar? It better. Once again, statement of owner's equity. Beginning capital plus any investments plus net income minus withdrawals. So I'm actually making my statement of owner's equity come true when I make my closing entries. This is where I actually update the capital balance. Those are your 2 closing entries. So while I'm erasing up here, I want you to do something for me. I want you to take your sheet of paper and I want you to draw a line through every account that we closed with those 2 entries. What accounts do we close? We closed our revenues, our expenses, and our withdrawals. Now, it's very, very important to remember that we used capital in the closing entries, but we weren't closing capital, were we? We were increasing it and decreasing it. So, if I take my trial balance and I draw a line through all of the accounts I closed, then what accounts are left that don't have lines through them? Your assets, your liabilities, and capital. What did we call those? Our permanent accounts. So they're not supposed to be closed. Our last step in our accounting cycle is to do what we call our post-closing trial balance. Post-closing means after closing. So the only accounts that are going to be on this trial balance are going to be our permanent accounts. Cash, all of our assets, liabilities are going to be the exact same balance that was showing on the adjusted trial balance. But capital has changed because if you remember just a minute ago, what did we do? We increased capital by net income and we decreased capital by the amount of withdrawals. So if I draw me a T account up here for capital, I can calculate my new balance. If I look on my trial balance, my beginning balance of capital was $15,000. In closing entry number 1, I increased capital by $31,500. And in closing entry number 2, I decreased capital by $10,000. So if I find my new balance, I would have $15,000 plus $31,500 minus $10,000, which gives me $36,500. So this is the number I will use on my post-closing trial balance for capital. All the other numbers that were on this beginning sheet, I will just be copying. So remember, our trial balances, we do 3 different ones and the names change, but what we're doing each time is the same. We're just copying our account balances from our ledger to make sure that our debits and our credits equal. Just don't forget, on that post-closing, you have to always make sure you're using this updated number for your capital. One more thing, because remember, we're in chapter 4, we're all about the big picture now, knowing how everything goes together. This updated capital balance, if we were working a whole entire accounting cycle problem, we would already know this number. That's right, we've already done our statement of owner's equity, and we've already calculated our ending capital balance. This just verifies it. So remember, like I've emphasized before, accounting, it all fits together. And so when we're working these problems, not in bits and pieces like we do most of the time in the classroom, but in the real world, we've already done our financial statements, so I've already calculated some of these numbers. It's the same. Everything is stemming from the exact same journal entries. So therefore, whether it's on the statement of owner's equity or whether it's on the post-closing trial balance, capital can only have one balance, no matter where we're writing it. Make sense? Okay, thanks for watching. Let me know if you have any questions, and I will see you soon.